I'm ready. Hello guys, Brad here from The Guided Investor. Welcome back to the channel, and just in case you're wondering, no, I'm not one of them crazy people that went out and bought all the toilet rolls in the supermarkets. That was just my usual stash. Before we jump into this video, I just want to preface it by saying that in this video, I'm going to focus on the financial implications of the coronavirus. Now, obviously people have died from this virus and that's horrible, and my heart goes out to all those people and their families. But in this video, I've got my finance hat on. So I'm not trying to be insensitive about any of this, but I am looking at it from a financial perspective, so go easy on me. Okay, so let's look at some of the figures around the coronavirus. At the time of making this video, there's been roughly 110,000 cases of coronavirus recorded, of which roughly 73% are in China. There is currently no cure for the coronavirus. All we have to stop the spread is quarantine. However, there are over 30 organisations worldwide currently working on a cure. There's been 3,830 deaths attributed to the coronavirus. That represents a fatality rate of around 3.5%. But it's important to point out that the fatality rate outside of China is estimated to be closer to 0.7%. Although that sounds like a lot of deaths, let's remember that the Centers for Disease Control and Prevention published a study in 2017 stating that they estimate between 291,000 and 646,000 people die each year from the seasonal flu. Also, those that have passed away are generally the elderly or those that have health issues. Here is a great study published by the Chinese Center for Disease Control and Prevention, which shows a breakdown of people affected. Now, the share market is definitely feeling the effects of the coronavirus. The Australian share market was off roughly 20% from its highs in February, which is a substantial drop. When events like this happen, there are generally two aspects to the market's reaction. First of all, there's the logical response, where people are sitting back, looking at the figures and working out how this virus is actually going to impact company profits and the way we live. And the second response is the fear response, and it's the fear response that can lead to really big irrational decisions. There is definitely a case for the logical response. The coronavirus is quite unique in the way that it's impacting both supply and demand at the same time. So supply is obviously impacted because there's restrictions on travel and restrictions on trade, and demand is impacted because people don't want to go out and spend money because they're scared of catching the virus. So a lot of businesses are going to suffer from profit downgrades in the short to medium term. Now, a profit downgrade is normally a micro event because it normally only affects that company. So obviously you're looking at that individual company and its profits, that's a micro event. But because so many companies worldwide are going to be affected by this, there's potential for all those little micro events to become a macro event. So there's definitely some logical reasoning as to why the share prices have dropped, because I think it is going to have some impact in the short to medium term. On top of the logical response, we also have the emotional response. Plus, all over the news are stories about how people are fighting in shopping centres over toilet rolls.
The fight over toilet paper that went viral around the world.
I just want one pack. No, not one pack.
China's ripping people from their homes. And people are buying up long life food because they think the world is ending. Now, all of these things are driven by fear. People are worried that the world is ending. And when you have fear in the people, you have fear in the market. As an investor, you can't let fear drive your decisions. And normally when fear is in the market, it's the perfect time for a level-headed investor to go in and buy some good quality assets to hold for the long term. So I guess the question is, am I personally worried about the coronavirus? And the answer is no. My approach to tackling the coronavirus is this. I'm a long-term investor, and as a long-term investor, I think that the coronavirus has generated an opportunity from an investment perspective. I believe that prices will fluctuate and be quite volatile in the short to medium term, particularly as more news comes to light. But I think that in the long term, the coronavirus is going to be gone. It's going to be a blip on our radar, and you would have had the opportunity to buy some really good quality assets at a decent price. In terms of when to buy into this opportunity, That's a very hard question to answer because it could get a lot worse before it gets a lot better. But at the end of the day, you know, I'm just picking away at a few holdings. I'm not arrogant enough to think that I'm going to pick the bottom of the market every single time, but I'm comfortable with my approach from a long-term perspective. So my plan of attack moving forward is this. If you have assets in the market, don't sell them in panic. They will recover. Just take a chill pill and remember that this is part of investing. You don't get those good long-term returns without the short-term volatility. I've started converting some of my defensive holdings into growth holdings. This means that I'm selling out of some of my cash and fixed interest positions and starting to buy more into growth assets. For those people with strong cash flow and a decent appetite to risk, I think it's also a good time to start considering a debt recycling strategy or something similar. Interest rates have dropped yet again this month, so the return that you need to get on your investments to cover the borrowing cost is lower again. If you're a pensioner, try not to draw down too much capital on your investments, because if you draw down capital in a down market, you crystallize that loss, and unfortunately you won't have that capital in the future to continue producing you more income. So just curb your spending a little bit when the market is down and you'll be right. Moving forward, I think the market will remain very volatile while the coronavirus is still an issue and there's been no cure found. But what I do believe is that when there's a cure found, the market will rebound fairly quickly because a lot of countries worldwide have implemented stimulus packages to counteract the negative impact on the coronavirus. So if you think about it, the virus is gone and stimulus is at a higher than when it was before. So that's a recipe for people to start buying into those growth assets again. Now, this is just my opinion, and of course, being an opinion, I could be wrong. A lot of people are saying that, you know, this is the start of a recession, which would mean that share prices are subdued for a lot longer. But at the end of the day, no one really knows. You got to take the approach that you feel comfortable with. And as long as you make an informed decision about which way to go, then have a bit of conviction in what you're doing. One thing I will say though is if you've ridden the volatility down this far, then don't sell your shares in panic. You don't need to be buying into new holdings, but it's the people who sell their shares in fear are the ones that lose money long term in the share market. That's it for me, guys. I would love to know your thoughts on the coronavirus and how it's going to impact markets, so leave me a comment below. Otherwise, please like this video, subscribe for future content, and I'll see you guys in the next one.